Welcome everyone. Shaily, thank you for joining us today.
Thanks, Milan. Glad to be here.
Thank you. For our viewers who may not be familiar with your work, let me start with a brief introduction. So, Shaily is head of products at Tata Asset Management and has over 18 years of experience in the financial sector. Given her deep understanding of the market and experience with both traditional and alternate asset classes, we are eager to hear insights from her on the upcoming Tata Nifty Realty Index Funds NFO. So, Shelly, let's get started with some basics.
Sure.
So, Nifty Realty Index has shown significant growth over the past few years. Shelly, can you discuss the primary factors that are driving this performance and how Tata Nifty Realty Index Fund plans to capitalize on these trends?
So, yes, let's talk about the trends currently which are there, and we can see trends across, the inventory levels, the demand situation, as well as the supply side. So, on inventory levels, what has happened is we were seeing from the peak of 40 months of inventory, which is, the stock taking 40 months to sell. That was the peak, recent peak in around 2017. From there, we have the inventory levels coming down to 16 months. 15, 16 months, which of course RERA has played a very important role there in crunching this inventory. So inventory levels are down. On the demand side, what we are seeing is post-COVID, as companies are moving away from the mandate of work from home, and employees are coming and joining companies back, and they're looking for homes near to their workplaces. And because of this, we've seen a sudden surge in demand across cities in India. In fact, the one of the reports read that the rental surges in cities like Bangalore, Pune are a good double digit 15, 16%. In Mumbai and Chennai, that number was about 8, 9%. So rental surges have happened because people are wanting to shift back near to their workplaces. People are wanting to again resume that metro lifestyle which they wanted to, and because of that, the rents have gone higher. And at some point in time, at this point in time, there is a camp which is wanting to do an outright purchase over renting it out. So that's the other thing on the demand side that we are seeing. So the demand has risen quite a bit for units, for houses. And also, while that has happened, one consumer preference change in consumer preference that we are seeing is people are wanting a little bigger houses. They have a preference for a slightly bigger houses. So if you see there has been a revival in the demand for premium housing also, which is more than 1 crore. And the mid segment, or the mid, segment housing, which is between 50 lakhs to a crore, that demand is very much steady. So on the demand side, we are seeing these changes. On the supply side, of course, supply is there where it is, and because of the demand surging, supply is not being able to meet that surge in demand very much. So these are the trends that we are seeing across.
Interesting. So, sector in essence seems to be in a sweet spot at this point where demand is rising, but the supply is to a level constant.
Yes, and one more thing, Milan, which is also helping is, in fact, two things. One is your incomes are rising, and the EMI to income ratio, which is actually an affordability, indicator, that has improved across cities over the last 4, 5 years. And added to this, you have interest rates which are at a point which are kind of pivoted or peaked out, and we are expecting the rates to decline, of course, once US Fed takes action, and maybe Indian Central Bank will follow suit. But both these things are further creating good demand drivers for the real estate sector, residential real estate sector, especially.
Interesting. And you were mentioning about RERA. So RERA has been a significant regulatory change in the real estate sector. So how has it impacted the real estate sector in general?
So RERA has been, one policy change by the government, which has brought in regulations which has increased the transparency and has provided protection to home buyers. In the pre-RERA era, there were projects where the details were not given properly, the timelines were not being met, and if home buyers were to raise complaints and they were to question some of the things, the resolutions were not proper, or there was no proper guideline for those resolutions. And more importantly, the monies which were raised through project sales, there was rotation happening. One project's money, there was no clear demarcation of the money raised from a particular project and the utility of that money, towards that project or any other project. So it was all over the place. I think what RERA has done is it has mandated a lot of things in terms of bringing in transparency. So advertisements are clear, your project details are completely given, they are given in completion rather. Project timelines are there, and there are provisions that if the project is not delivered timely, then penalties are supposed to be calculated and given out to the home buyers. And one very important provision or one very important regulation is that there is a separate escrow account for each project, and 70% of the monies which are coming into that escrow account through the project sales, whatever money is coming in, 70% of that money needs to be used for the same project itself. So the money rotation is in check, and that is why you will see in the last 2 years, whatever launches have happened, project sales of those projects have actually happened. Majority of it has happened in the first year itself. So all these things have brought a lot of tightening, regulation, transparency, and protection for the home buyer.
Hmm. And there has been observation that post introduction of RERA, post pandemic, the market share of listed developers has increased. Do you see this trend continuing going forward?
Yes, of course, multiple drivers to that, or multiple factors leading to that. But as you rightly pointed out, one of the most important factors which RERA has brought in is that it has made the listed players. It has brought in consolidation towards the larger players, and yes, the market share of real estate developers has gone up. In fact, 5 years ago, their market share was about 13%, which has now gone up to, as we speak, about 19 to 20%. So definitely, the market share gain has been there, and their booking value has gone up. Obviously, their balance sheets have become much more robust. So the big is expected to get bigger and more robust. Yes.
Okay, so pretty interesting way in which the sector has been moving from the laxed way to a controlled way under RERA. And as you mentioned earlier, there has been a thought, there has been a view that interest rate would come down in 24 or 25, and that has sentimentally also already started impacting performance of various real estate companies, especially their stock performance. So according to you, definitely once the interest rates come down, affordability will increase. So what implication does it have on an investor in realty index fund based on this?
So see, whenever the rental yields go beyond a particular threshold, obviously investors would like to move to buying the property outright, the real estate residential property outright, and that's what in the recent times has happened. That I think pre-COVID the rental yields were at around or the average pre-COVID, the average pre-COVID has been about 3.5, and as the rental yields move closer to 4 and beyond 4, obviously the preference for buying the real estate property outright goes up. So that's what has happened. Also, we've seen that the as I mentioned earlier, the premium segment that has seen a great revival. In fact, out of the entire real estate sales pie 5 years ago, the share of the premium segment was about, I think, 20%, which has now moved to 35 to 37%. And the affordable segment, has actually moved down from 40 to 30%. There, some bit of revival would come in as per capita income rises, and we all know that India is talking about 5,000 per capita income, by 2030. So that's what we are looking at. And once that happens, automatically, as the per capita income rises, you have essentials and staples, and electronics. That's the first leg which sees the positive impact. Then comes your auto, and then comes reality. So as the per capita income rises, it will have a positive impact, on the real estate sales. It will be one of the key drivers of the demand for reality, and that will definitely have an impact on the reality index itself. This index is purely of residential developers index. In other housing opportunities fund, you would have some 6 to 10% allocation, or maybe not more than 15% allocation to developer space. But this index and this index fund is all about the residential, capturing the growth of the residential developer companies, real estate companies. So obviously that positive impact will be captured, is expected to be captured by this index very well.
Interesting.
And also the mid segment demand, which is between 50 lakhs to 1 crore, that's very steady. So revival already seen in the premium segment, affordable segment revival is awaited, and the mid segment remains very much steady at 35% of the overall sales pie of residential properties.
Wow, interesting. And finally, could you elaborate on this NFO of Tata Nifty Realty Index Fund?
Sure. So this, as I mentioned, it is there to capture the growth of the real estate developer companies, residential developer companies, and the stocks here are laid down in the descending order by their free float market capitalization, and the top 10 stocks are picked up. There is a cap on per stock, which is 33%, not more than 33%. Can be the weight of any one stock. So that's one rule which has been put in. And the review and reconstitution of this index is biannual, which is every 6 months it happens, the review and reconstitution. Also, the way this sector is, it is, there is the cycle similarity there within the subsectors of largest of the sector like real estate is very, very high, which means the interest rate or the demand supply dynamics are the two segment drivers for this entire real estate. That's one part. Second is there is uh, decent amount of market cap concentration which is there with a few stocks or a few players in the index. So both these reasons actually pave a good way for it to be a passive index. For an investor looking at capturing this space, it's good to capture it through the passive index because of these reasons. Because when you have a higher concentration which is there, taken up by a few stocks, not much difference can you bring in the active fund as well. You would have to be, if 30%, let's say, is held by stock A, in an active fund, you can't make it a 0 or a 4 or a 5%. You will be around that. So that is one important thing. And also the segment drivers are one or two for this segment. So, the sub-segments also move in tandem. So this makes a good case for an investor to look at the real estate sector through a passive index. Just to add here, some 81% of the 81 to 85% of the market cap of the overall real estate sector is captured through this index, Nifty Realty Index, through 10 stocks. Yeah.
Got it. Shaily, thank you so much for taking out time for this session, and all the best for the NFO.
Thanks, Milan, and totally a pleasure to be talking to you and your clients and investors. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.